Now turning to Netflix, as its third quarter results are just hitting the wire, and you can see the stock is down a quick 5% here in the after hours. Q3 EPS, let's start there, 587. She was at 694, so that's a miss on the bottom. Q3 revenue, top line, comes in at $11.51 billion. Street was closer to $11.52 billion. Let's turn ahead. What do they see in Q4? They're saying Q4 EPS, they're looking for 545. The estimate was 542. And for Q4 revenue, they're saying they look for 11.96 billion. The street was at 11.9 billion. And now turning ahead, full year revenue, they are calling for 45.1 billion. They had seen between 44.8 to 45.2 billion. So the stock is down a quick 7% here in the after hours. You know, it had a run into this print. Remember, we were up about 40% year to date heading into this report. Some other big questions I know analysts are going to have. More color and commentary you're going to want on viewer engagement. That's a metric, remember, we still get. You had that smash hit, K-pop Demon Hunters, global sensation, trends and themes in the advertising business, how the company's thinking through that mega AI trade and trend. And of course, we did hear today a report that Netflix possibly interested in Warner Brothers Discovery, or at least parts of that company, so you can be sure that is going to come up on the call as well. But we're down a quick 6% here, at least initially, in the after hours. Let's get right to these results, Geetha. You know, I mean, the stock was up about 40% year to date heading into the print. Down in the after hours here. It sounds like Netflix, Geetha, is calling out this tax dispute with Brazil. They're saying that's what really sort of impacted the quarter here and the bottom line. But walk us through it. What do you see in the report?
Yeah, I think that's the first thing that, people kind of really looked at in terms of the operating margin and why they missed. I think investors were really looking for management to actually increase their operating margin guidance from 30% for the full year 2025 to a little bit more, maybe 31, 32%. They've actually now taken that down. And it looks like a lot of that can be attributed to the 3Q operating margin miss. So definitely somewhat underwhelming, just because we know that both third quarter and fourth quarter is supposed to be one of their best content slates ever. We've seen some very, very strong and encouraging metrics when it comes to engagement. You had the breakout hit with K-pop Demon Hunters, so all of that was kind of really feeding into, I think, this investor frenzy for better results. But, obviously the tax dispute was something that nobody could have foreseen.
They are, it sounds like, touting, Geetha, what they're calling record subscriber engagement. What are the trends and themes there? What are your questions around that metric?
Yeah, so that's exactly what they've been telling us all through. So the first half, and they already reported metrics in terms of, overall viewing hours, overall engagement, that was somewhat muted, I would say, from the first half of this year when you compare it to last year. But then you look at, if we've just run some internal numbers as well, you look at the third quarter engagement metrics, really, really strong. And that's exactly what they're referring to in their investor newsletter. We've seen something like a 20 to 22% surge in engagement. And a lot of that just from all of those big monster titles. I mean, you have 3 of their most watched ever series just debuting in the third quarter. You have, K-pop Demon Hunters, which we just spoke about, biggest movie of all time, which came up in the third quarter. And then, of course, you had Squid Game season 3, as well as Wednesday season 2. Again, some of their most watched series ever. So all of that really driving very, very good engagement. And remember, engagement is the way that we are going to kind of evaluate this company going forward, because content drives engagement, drives monetization. And that's really where Netflix's pricing power kind of is anchored.
Geetha, I feel like I got to ask you, I'm sure you saw the report today suggest that maybe Netflix is one of those parties that could be interested in Warner Brothers Discovery, Geetha, or at least parts of Warner Brothers Discovery. What do you make of that? If you saw that Netflix really made a move there, would that be the smart move strategically?
Strategically, yes, it does make sense. I mean, they do have some very, very compelling, IP that would, help them with subscriber trends, that would help them lower churn, increase engagement. We just spoke about engagement. So all of that, yes, it makes sense. But traditionally and historically, when you've kind of seen Netflix's strategy over these past so many years, they've spent about $1 or $1.5 billion totally on M&A. So really, they've been very, very shy. There just hasn't been that appetite, and investors have kind of liked that build versus buy strategy. So I don't think anybody was really expecting Netflix to kind of come out swinging. Having said that, though, this is a once in a generational opportunity. Warner Brothers is a great studio. There's a great studio lot there, and there could be a whole lot of synergies that Netflix can achieve with the combination. So again, it's a little bit of a wait and watch, but I don't think it's a make or break for Netflix.
Geetha, let me ask you a bigger question, longer term. This question of sort of AI content creation, Geetha. OpenAI working with Vertigo Films, first feature-length film premiering next year. What does the mega AI trend and theme, Geetha, mean for Netflix in the quarters and years ahead? I mean, is it a tailwind? Is it a headwind? Is it potentially both?
Yeah, it is potentially both, but I think in the near term, it's actually going to end up being more of a tailwind for Netflix. They're already using AI pretty effectively. They've used it in their user interface for better personalization, better rankings and recommendations. Remember also when it comes to content production itself, Netflix is already using AI to create better visual effects, de-aging, for instance. So better content, faster content, right? They can make content much, much quicker now, kind of using the text to video prompts. And also cheaper content. So, we just ran some numbers and we said that using AI across the board can help trim content costs by at least 5 to 10%. That's a sizable amount of savings. We know that Netflix is spending something like about $18 billion. So you're looking like something, like about $1.5 to $2 billion in cost savings over time, which is pretty substantial.
Geetha, always great to see and to have you on the show. Thank you.
Thank you.
So we have seen this resurgence in deal activity, in IPO activity as well. Do you think that it is going to be sustained through the fourth quarter and going into next year?
I would think so. In fact, I think there's significant momentum building up. You have a combination of companies that are looking at how they can change the fundamental dynamics of what they have through mergers and acquisitions of entities that can help them grow faster, become more efficient, deliver their products and services to their customers much more cost effectively. And you now have a regulatory environment that is significantly more rational than what we saw in the prior 4 years. And I think the combination of those two things has given strong impetus to a reinvigorated M&A market. And then you can combine that with the fact that the debt markets are incredibly cooperative right now. While the base rate is higher than it was when money was free, the spreads are as tight as they've ever been in history, and terms are quite good. So whether it's a private equity acquirer, so-called financial sponsor acquirer, or it's a corporate-to-corporate deal, I think you're going to continue to see significant uptick in deal making.
And Scott, there has been concern broadly about the private equity business that it's going to be harder, it has been harder to do exits, to get money back to folks who are investing. Does this mean that outlook is also considerably brighter?
I think you're going to see more exits occur because of this dynamic. I do think that in the industry overall, you've seen a period where valuations of companies that were acquired, particularly in 2021 and into 2022, were such that it's taken more time to grow into the kind of expected returns that you have, and therefore there were a lot of companies that were just not quite ready to have a realization event. And you're going to start to see more of that happening, I think, over the course of the next couple of years, as that large inventory of companies that was acquired in that 2-year period will become mature enough for a realization event.
Scott, I'm also curious, you're certainly not the first person to talk about the regulatory environment getting better, and that's one of the favorable things. Well, what's the risk of the pendulum swinging too far, which tends to happen, right? After you have what people see as too much regulation, then maybe does it go too far in the other direction?
I don't think we've yet seen that over excess the swing in that negative direction. That's not to say it couldn't happen, but I do think that the regulatory authorities, FTC, DOJ, most of the policymakers and the legislative side are all very focused on, again, a rational and prudent set of antitrust policies, with really a return to focus on the fundamentals of that policy, as opposed to just saying no. So we're not yet seeing that issue. Obviously, there'll be a few things happening that we'll see how the regulators react right now. But I think people are fundamentally looking at what's best for the customers, what's best for the consumer at large, and is there a prudent rationale for some of these consolidations?
Right.